Hello, everyone. Today is June the 10th, 2023, and this is another episode of Two Grey Beards.
Hey, Nick, how are you?
Good. So, what do you think happened last week that was interesting?
Well, the data was relatively benign. There wasn't significant economic data during the week. What data there was, PMIs, ISMs were mixed and really were not particularly indicative of any sort of trend or change. Some were strong, some were weak.
Yeah, I think it's data that could be interpreted any way, which way you like, especially the unemployment claims, which were for a holiday week and are subject to revisions. So I really wouldn't change my mind on anything based on that data that we had last week. It's subject to revisions and it wasn't particularly, one way or another. So really a week of nothing much.
Right. And then the other thing that was new is that the debt ceiling had been lifted and signed the prior weekend when the issuance came to market. And it came to market only in bills. This was a week, every other week, basically, when there are no bond issuances. So it was all bills. And initially, the bills rates that happened, so quite a bit of issuance, a couple $100 billion. And initially, Monday, I think it was, the rates were higher than current RRP rates. And, that's indicative of weak demand, obviously, and that demand coming from a combination of bank reserves and maybe possibly some of the RRP transitioning over to the bills market. But by the end of the week, we saw the RRP down modestly, $20 billion. And what we also saw is the rates on the remaining bills that were auctioned at or below the RRP rate, which means it was funded by bank deposits as part of the bank walk that we've referred to and others have referred to, where depositors are saying no mas for the zero interest rates that they've been receiving and transitioning to both money market funds, which have grown, and bills. And that bill demand generated a relatively low rate on the bills that were auctioned.
I think another interesting snippet is that both the Bank of Canada and the RBA hiked their short-term rates, even though there was no expectation for that. I find it hard to believe that any central bank can out-hawk the Fed. So to me, that is an indication that we're going to get something hawkish next week from the Fed itself. But let's discuss that in the next segment.
Sure, but leaving that one other point on that, both the Bank of Canada and the Royal Bank of Australia did pause and then hiked when they saw the pause didn't that it's not the pause that responds, but the prior hikes had been inadequate and data continued to warm. And that's one idea that the Fed is going to be kicking around, is a pause okay now with a hike in the future. And both the RBA and the BOC having done that is interesting. What about markets? I saw short-term rates continuing to climb faster than long-term rates. That's a bearish flattener, as we've described, and consistent with what you might expect.
Yes, but it was pretty small. I
Yeah.
think 8, 9 basis points movement in the curve, nothing huge, and really probably more of a sign of the issuance that we are having on Monday and Tuesday, and people setting up shorts for that, because we do have a lot of 3s and 10s on Monday, and then we have 30s on Tuesday after CPI. So it's going to be very, very interesting to see what happens next week. And really, we should talk about our expectations for what the Fed is going to do, and the ramifications of what the Fed does and says are going to be next week.
Sure. Before we talk about next week, let's close out last week. What about equities? Did you notice anything technical on equities? It was fairly technical.
Yeah, I mean, let's step back. we've had a very, very strong move driven by these AI stocks and this AI mania. And none of us really know how far that can go. I mean, how long is a piece of string? That mania can continue for a long time. So when that sort of thing happens, I tend to rely quite a bit on technicals to tell me when we could be cooling down. And the one thing that I've noticed is that last week we had a doji, as I explained in XLK, which is the technology part of the SPX index. And this week we've had a doji in QQQ and in the NDX itself. To me, that is indicative of hesitation. It does not necessarily mean that we're going to collapse, but it means that the odds are shifting, that we are not in trend anymore, and that we could be quite volatile, possibly within a range for a while, and then we get the resolution of the range, either to the upside or the downside, but the odds are shifting that it's to the downside. So I think we're going to have a very volatile week, and naturally the Fed's decision is going to be the catalyst which precipitates it all.
Right. So let's talk about next week. So next week, we have quite a bit of issuance, as Nick hinted at, particularly on Monday and Tuesday. Auctions at 11:30 on both bills and 3-year notes, auctions at 1 o'clock on both bills and 10-year notes, total amount close to 200 billion, and then 30-year bonds and more bills on Tuesday. Tuesday, we also get the CPI number, which will be very important. And on Wednesday, we get the PPI number, which will be less important because we'll all be waiting for the Fed. But at 2 o'clock, the Fed will speak.
Yeah. And really, the market's pricing is, I wouldn't say odd, but interesting. They are pricing more of a possibility of hikes in July than June. But they're not certain. They're hedging their bets, as they should, because it could easily be that we get a hawkish pause. So let's talk about the various options that the Fed has, because let's not forget that we get another set of dot plots, which I think are going to be far more interesting than what the Fed does.
Yeah, absolutely. I mean, we know there's two possibilities for the big bright red headline and all the people talking on at the moment at 2 o'clock, and that is whether they hiked 0 or 25. And to us, it doesn't matter much, and that it's much more important to look at what the dot plot has to say, even more so possibly than what the press conference has to say. And so let's just review that briefly. So what the dot plot is, they survey the entire board of the Fed, the whole FOMC, and each one pencils down their views of what is going to happen in the economy between the end of December 2023, December 2024, and December 2025. So what seems to me likely is they are going to increase their expectation from what the prior dot plot, which we saw during the banking crisis in March, on pretty much all dimensions. But starting with the economy, they had a 0.5, 0.6 level for the real GDP for the year. I'm fairly certain they'll increase that. They had a unemployment rate, an expected unemployment rate of 4.6, 4.7. I'm sure they will have to decrease that rate. And they had a core PCE of 3.5% for the year 2023, and they're going to have to increase that. And so those are the economic outcomes. And it just speaks to a stronger economy than they thought of during the banking crisis.
Yeah, absolutely. And let's face it, during the banking crisis, they had no idea about how much it would impact the real economy. And now we are seeing, we are 3 months after that. we're seeing that the impact on the real economy was actually minimal, if any, as yet. And therefore, I absolutely agree with you, all those numbers will be revised. What is uncertain is how much they increase the terminal rate by. And I think that that is going to be absolutely key to the way the market responds to the dot plot. And I agree with you, whatever Jay Powell says during the presser can influence things at the margin. But the dot plot is going to be the thing that absolutely moves the market in the first place. So my personal expectation is that they do increase by 25 basis points in June. I could be right, I could be wrong, neither here nor there. But I think there's a sizable probability that they don't increase in June, but they telegraph an increase in July. How would they telegraph an increase in July?
Right.
Is
So,
by moving the dot plots up to at least 525, if not higher. Anything between 525 average and 535 average, that is a hawkish pause. And that is what the market will react to. I think in that case, you will get a further flattening of the yield curve because let's face it, why keep on paying negative rates to fund your positions in the short end? It just doesn't make any sense. In which case, the 1 year, the 2 year should move up by about 15, 20 basis points in yield, while the long end should theoretically not be bothered because they are actually doing what is necessary to contain inflation. They're remaining tight enough. They are doing the right thing. Therefore, the long end, the 30 year, could even rally slightly.
right. So
Let's talk about what
let's
happens if it's lower than 525 or higher than, say, 540.
sure.
Those are the very interesting extremes.
Right. So I agree with you on that. Let's just step back to ground people. The last dot plot was a yield of 5.1 for December of 2023. Okay, so what does that mean? That means basically they expected to hike. They hiked in March. They expected to hike and did in May. And 5.1 basically represents right this very moment the range where we are. Literally, Fed funds is at 5.1 right now. So what would it mean for them to not, so sort of by definition, a 5.1, no change in the SEP would mean they didn't hike and they are saying they're done.
Yeah.
In that case, to me, the very obvious thing would be equities would rip higher, gold would rally a lot on the risk that the Fed was going to give up on inflation, and the long end of the bond market would sell off quite a bit.
Yeah, I would argue with the gold thing. Insofar, I don't think it's going to be a gold move by itself, but I think it's going to be a relative move between gold and nominal bonds.
I agree with that. Gold may not go up a lot. It'll only go up a lot if there's real fear that inflation is still persistent and the Fed missed it. But certainly equities will benefit from a 5.1 number. So
Yeah.
let's just take the other possibilities, which is, you know, if they raise by 25, it seems very unlikely in June. It seems very unlikely that the dot plot would be any lower than 535, which is the 25 basis points added to the 5.1. So my expectation is if they hike, you're going to get a 535 minimum on the December hike, and you're going to get a possibility of maybe a 50% chance of another hike. And so that would, to me, sort of generate a SEP number that is closer to 5.5 if they hiked.
Yeah.
So what do you think would happen on a 5.5 going from 5.1 to 5.5.
You would get a marked flattening of the yield curve. Long bonds could even rally. They would certainly rally against gold, and you would get probably a down 2% day in at least in equities, probably led by the high beta stocks like the Nasdaq.
Right, I agree with that. So now we're looking at one scenario, which is a hike and a 5.5 number. I could see it happening, and we've said what the reaction would be. What do you think happens with a pause and a 5.5 number? Because the natural thing in a pause, assuming they do a hawkish pause, would be sort of a because they don't have to mechanically lift the 5.1 up. It would be a signal that they plan on moving in July, and you probably get that 5.25, 5.35 range. What do you think would happen if we had a pause and a 5.5% range?
I think much the same, just slightly less in intensity and magnitude.
Yeah,
I,
I
I
would expect on the headline, and we're talking about day trading right now, I'd expect on a zero headline, equities would rally. And when looked in more closely at the 5.5 SCP print, would aggressively sell off, maybe not
yeah.
quite as aggressively if they hiked and went to 5.5.
No, absolutely. I mean, from a day trading perspective, the ideal would be nothing followed by 5.5%. That would be, a massive, up 1%, down 3% kind of thing. And that would be some sort of a key reversal. And then it would continue to bleed for weeks to come, probably.
Right.
So that would be the ideal from a day trading perspective. But these, are we that lucky kind of thing?
Right. So one thing I was also interested in is the prior dot plot took the 5.1 number for December and dropped by 100 basis points for the following year, and indicating that when they reach terminal a year later, they will begin a cutting process. Given their likely to increase, the inflationary numbers, the GDP numbers, and decrease the impact on unemployment, what do you think will happen to the 2024 rate if they raise to, say, let's pick 535 as our minimum? Would they raise by less than 25 basis points for next year, or would they, which would suggest more cuts in 2024? Or they've said they want to really suggest a pause. If they raised from 5.1 to 5.35, would they raise from 4.1 to 4.5, meaning to try to take out some of the cuts in 2024?
I think they're likely to want to do that in any case, simply because if they want to signal higher for longer, and that they want the market to help them to do that, that is the way to do it. Hike up the 2024 and 2025 numbers, because the market is aggressively through them.
Right.
And if they want to tighten financial conditions, that is another way to do it. A very simple and painless way for them to give the market the signal to do it. I mean, I agree with you in general that financial conditions have actually significantly eased over the past 3 months. How happy are they with that? I don't think they're very happy with that, simply because they are the key metrics that they look at, like, core PCE and other data, is not falling faster than their expectations. And therefore, one way for them to signal their displeasure, and that the stock market certainly should come back to where they would want it to be, as because let's face it, the level of the stock market does impinge on how wealthy you feel, how much your propensity to consume is, etc. If they want that to be lower, and they want the market to help them in that, certainly an easy way would be to hike up 2024 and 2025 more than the market expects.
Yeah. Okay. So I agree with that. Also, it's a subtle thing to look at. We're running a little long. It's a big, big week. So we want to spend the right amount of time with you. What do you think about our portfolio?
We didn't do anything last week. Our offer didn't get taken out. I think that we just leave it for the time being, and we could get lucky. But since it's such an important week, and the decisions that are reached on Wednesday are going to really be key for the next several weeks, I think we should do another episode on Wednesday or communicate via email, depending on how important the event was, the outcome was, and make sure that our subscribers are absolutely fully informed as to our thinking.
Great. I agree. We'll do that. The one thing I would mention is that one noticeable market event is the very low VIX, which is broadly measures in the implied volatility of options. One thing we won't do for our portfolio, it's too small, it's not, but as an asset manager, it seems like a sensible time to at least buy some puts on some of your portfolio.
Yeah. Whether you reverse sell your position and buy calls instead or buy puts against your position, it's the same thing. And therefore, at this level of volatility, it has always paid to do that, but not in short-term options. We are talking about longer-term options, something like 3 months, 6 months, or even a year worth of maturity length. So I am beginning to do it for my own portfolio and will continue to do it on Monday. Buying protection here is not a silly thing to do.
Great. So we'll see you on Wednesday if something significant comes. Otherwise, we'll see you next week.
And in any case, the least you will receive is an email with our views. Thank you very much. Our portfolio last week did not change. I've updated all the figures so you can see the exact proportion of everything of each asset class that we hold. I've updated the chart pack. The broker statement is also in here. And for the orders, we are leaving this order open at 343 in the Dow. It obviously did not get filled. And as I've written here, we are anticipating changes after FOMC, and we will be contacting you either by email or by video if it's important enough, with explanations of why we are doing and what we're doing on Wednesday. Thank you very much indeed, and look forward to communicating with you after the FOMC.